Hello, this is the first bet. And every successful person gets interviewed about how they won. Nobody drags them back to the moment before it all began to work, when the information was thin, when the money was real, and they pushed their chips in anyway. And that's what we do here at the first bet. I'm Martin Tobias. I'm managing partner of Incisive Ventures. And I've bet three ways: as the CEO building a company, as a pre-seed investor, and as a poker player. Today's guest has spent 20 years closing 50 plus deals across three continents, including a $1.6 billion LBO. He walked away from all of that to make a very different bet: that the entire venture capital industry was running on the wrong operating system. His thesis is pretty blunt: that intuition, the tool most investors treat as a superpower, is demonstrably unreliable in early stage VC because intuition only works in environments where they have clear feedback loops. Early stage venture is not exactly that environment, and he built a framework to replace it, has trained dozens of GPs and hundreds of founders on it, and is in fact now pursuing a doctorate to nail that academically. His name is Aram Attar. He's the founder of the VC Factory and architect of mindset-based investing. He's also an LP in Incisive Ventures Fund 2, my fund, which means that he's already applied his framework to me, and maybe we'll get into that a little bit more and talk about how that worked, or maybe how it almost didn't work. Aram, welcome.
Thanks, Martin, and super happy to be here.
Okay, super. Well, maybe you can, take me back and just start with a little bit of background. You'd done LBOs and growth equity and things like that. And how did you decide to make the transition into thinking about mindset investing and how to make low information decisions?
So after 15 years being an investor and advisor, I started teaching VC first to students, and then very quickly I started teaching people, aspiring VCs, people who wanted to be into VC, and then VCs themselves. So I had an online program. It was called the VC Career Accelerator. I took it off now because I'm doing other things. And then the question that was coming every time was, how do I make better decisions? And so I started listening. It was 2018, right, when I started. So I started listening to people who at the time were vocal on VC: Brad Feld, Fred Wilson. It wasn't like every VC had a podcast like today. So I started listening to those really good people who had repeatedly made billion-dollar outcomes, people I call power law masters, because they really tamed the power law. And the mindset-based investing framework imposed itself to me because all these people talk about is psychology. And that's what mindset-based investing is it's a tool to make improved returns at every capital allocation step. So LPs to GPs and GPs to founders, recognizing that the mistakes we make or the successes we make are largely in our heads. So we have those biases that make us miss as a GP a great opportunity, or as LPs make us stay away from one of the best segments, which is your segment, Martin, emerging VCs.
Okay, great. So maybe you can take me a little deeper into one thing you discovered, which I think is counterintuitive to some people, that intuition, doesn't work. Do you have any data around that? And then summarize for us the pillars of your mindset, the decision framework that you have that's different from intuition. So why does intuition? Why can you not trust intuition in a low information environment? And what are the pillars of your framework that make it different?
Okay. So the framework is, how do we pick the best GPs? And my analysis, which is very qualitative because you have only 20 to 30 people in VC who have made repeatedly outlier outcomes, right? And it seems to me, it's still work in progress. It's been 10 years we're working on it, but I'm doing that full time. That they are making the decisions in 3 steps. And you and I talked about it when you were kind enough to come as a guest at my event at South by Southwest this year. But basically, it seems like those people, these power law masters, are good at having the intuition, but then pausing it, delaying it. Then they're collecting data, and they're usually collecting data in a scientific way. It means they really are trying to fight confirmation bias and all those things that make you fall in love with your own ideas. And then when they make a decision, which is the third step, they seem to have what we know psychologists call a promotion focus. They don't really care about the loss. They're trying to win. They're not trying not to lose, right? So these are the 3 steps, and intuition is the first step in this 3-step process of making, hopefully, outlier decisions time and again.
Okay. So your thesis isn't that intuition is bad, that it might give you a good guidance as a place to start. But if you're in a low information environment, the next step beyond intuition is to try to narrow that information gap. And, in VC land, we do due diligence. I know some VCs that are like, so and so's investing, I'm going to YOLO in right behind. And they sort of skip the diligence thing completely because it's a hot deal or it's closing by Friday or something like that. And you say don't skip the information gap, because one of the ways to improve decision making with low information is to try to bridge the information gap as much as you can. And then that third part that you're talking about is something that other people have mentioned, which is to place bets which have an asymmetric return. And I think
Yes.
that's different from real estate investing or something else where you have a fairly reliable, you can run a spreadsheet and you have a fairly reliable 15% return, and there's tons of data behind it. But you're never going to make 100 times your money in real estate, but you can make 100 times your money making these kinds of decisions. And so therefore having a bias towards asymmetric returns, even in low information, is how you can compensate for low information. Is that in poker, they call it the pot odds. If you're making enough of a return relative to the risk of success, if you have a 10% chance of working, but you're making 100 times your money, those pot odds make even making 10% bets worth your time. Does
Yes.
that?
So let me take the poker exactly. You nailed it. And I listened really carefully to your first two episodes, and I'm a huge fan of the podcast already. And so
Thank
let
you.
me tell you what, because I'm not a poker player myself. And so I was listening to your first episode, and there are two differences with poker and VC that I think are going to highlight what mindset based investing is trying to do. Because in poker, you have two things that help you deploy what psychologists call expert intuition. Expert intuition is you're a firefighter. That's a classical example in psychology. You're a firefighter. You come into a house that's on fire. Something feels wrong. As a captain, you pull all your firefighters out, and the house crumbles. And that has happened time and again. People have written papers, peer-reviewed papers on it, and you wonder why. Same in chess. You have some masters, grandmasters. Magnus that's what he said last time was, I feel my intuition is better because I rely on my intuition to win. Okay, so that works. Why? Because of two things, and that's based on the work of Daniel Kahneman, of course, and others, is you have what you said before, you have rules that work, and then you have a feedback loop. And in poker, you have rules, right? Because if
Yes.
you can't do whatever you want. So if you apply the same things, you're going to have the same results. And you have a very, very short feedback loop, right away, right? If you're right or wrong. And you guys play so many hands in a night that you can build that expert intuition. Now, the problem in VC is that VCs, they have only one of those three aspects, is that they make a lot of decisions. And so they think, and they see a lot of deals, and they think, wow, I'm pattern matching. So they think pattern matching is at some point is a God-given gift. It's a mystical thing. That's why I started my report with intuition is not a mystical gift, right? Because intuition is only recognition. It's only a recognition of what you've done before. So you have that. But in VC, what you don't have is, as you know, Martin, because you've been an entrepreneur before you were VC, you don't have rules because you could invest in five founding team, have the same quality, same idea, same whatever, and maybe four fail and one succeeds. That's due to other things, probably luck and timing and many other things. So you don't have a rule. Otherwise, everyone would be investing in the same deals. And
Uh-huh.
two, you don't have a short feedback loop because it takes a year or two to have even another round, and then it takes maybe 2 or 3 years even to fail and so on. So it doesn't really work in VC. And so that's the conclusion I came to based on the work of top psychologists, including Daniel Kahneman.
Yeah. That's definitely the feedback loop is definitely missing in venture unless you've been at it for 20 years. So let's go back to your decision that you made to become an LP in my fund. How did you get through those three things with that capital allocation decision?
So on investing as an LP, I started because I thought, where is there urgency of applying mindset-based investing in VC? And I think LPs missing emerging VCs is horrible, because that's where, if you look at the numbers we have, we don't have a lot of numbers on that, but you have a Cambridge Associates has this chart where you look for last 10 years, where 20, maybe 6 to 2016. So last 10 years, that makes sense because of, the life of the funds. The top 10 funds every year. And out of the top 10, five, half of them are fund one and twos every year. So
Every
every
year.
year for the last 10 years, and then maybe two are fund three and four, so still qualify as emerging managers, and then one or two are established players. And the problem is you have thousands of those, so only the top, I don't know how many percent, maybe 1%, 2% of emerging VCs are outperforming everyone else. But then you have a long tail and you don't know how to pick, because the problem is in VC, for the reason that science has not confirmed, LPs are using track record as a metric to pick funds.
Yes.
And if you look at, it's a phenomenon called persistence. If you look at this couple of papers on persistence, it's not confirmed that there is persistent venture capital. Like the probability that if you have a top quartile fund, this fund, the next one would be also top quartile is like 30%. So it's less
Yes.
than, flip of a coin. So that's a problem. And which I call the emerging VC conundrum is you, as an LP, are leaving a lot of money on the table because off the table, sorry, because you were on the table because you are trying to you avoid this pocket of people like yourself who are super successful,
And
super performing. And the I'm not crazy, right? I started putting my own money behind it, so I didn't start with my bright ideas. I took a team of three researchers through three of my MBAs. We spent months going through how do top LPs today pick emerging VCs, and we look at how Beezer Clarkson from Sapphire Partners, I think she left now, but she was there when we did it.
yes,
Michael Kim
she's
at
at Gem.
Sandana. Exactly.
Yep.
She's a gem. And she and Michael Kim and Samir Kaji, who's not technically an LP, but he's the OG in the space. He's been talking about LP investing forever. And so we went through hundreds of podcasts, articles, you name it, blog videos. We with AI, but then we checked everything manually. And we found that they have those 6 rules that they apply consistently. And my work in the first report I wrote was that those 6 rules can be traced back to mindset. And so, long story short, for example, one of the rules is how have you worked on investment thesis? What's the size of the fund you're going for, and so on. This is really linked to mindset because, as you know, GPs like founders, they tend to go for huge funds. Like founders ask for too much money and GPs ask for too much money. Now, if you have a GP who has a solid investment thesis and asking for 5 million maybe to test themselves and show they're good investors, maybe there's something in that mindset that shows that they are grounded and maybe they are going to be a good investor. So that's what I do is I try and use my own framework to invest in emerging GPs before they have a track record. And it's
Okay.
based on two things. One is how do you build your firm? So in your case, same thing. Like, are you investing or are you spending all your time traveling to nice resorts where LPs are and so on? And I've made mistakes. I put money in people who are going to resorts and they never raise the fund. Okay. So what are you doing? Are you as an entrepreneur? Are you building the firm? Are you talking to your startups, trying your thesis, trying to get the money you want? Or are you doing something else? That's one. And I think, LPs should learn how to evaluate GPs as founders first. And then are they trying to win or are they just trying to not lose? So are they really trying to take risks? What is the decision-making process? And I'm happy to give you examples of your own process that seduced me if you want.
Yeah, sure. Okay, we can do that. So when it seems like you make a decision to deploy capital in emerging manager very different than a lot of other LPs might do. And if I heard you correctly, the primary mistake you see other LPs making is that they are overweighting the replicatability of a track record. They would rather invest in funds 3 and 4 of somebody that's done some average returns than to look for where the alpha is, which you see showing up in Cambridge reports, which is all of these fund ones and twos. So you think the primary and I think part of it in institutional LPs is a confirmation bias of buying the brand name. Nobody ever gets fired for buying IBM. In VC, you might not get fired for investing in Andreessen Horowitz or Sequoia or something like that, but a lot of times you just can't get into those. So you think the primary
Exactly.
mistake most LPs make is overweighting this replicatability thing, which you've seen in the research doesn't hold in venture capital.
Exactly. And you have two pockets. The large institutional LPs, they're probably never going to change because they also have to put a lot of money to work and they can't write, 20, 200, $5 million checks. So for them, it's maybe the way they do it is okay for them. But the people I'm talking to mostly are people like me who are people putting 100K, 50, 100K to $1
Yeah.
million in funds. And as you said, they don't have access to the Sequoias and Andreessens of this world anyway, right? And so they're shutting themselves from a huge opportunity to try and invest in earlier managers, people in fund one and twos especially. You're right. That's a problem, and the problem is they don't really know how to evaluate those
And
because there's no track record.
you've given them a framework, and that's really good. Maybe you could go back to I mean, obviously in my fund, a lot of things passed as a yes, but what were some of the flags, or what were some of the things that were a case against that a lot of LPs might come up against with this kind of thing? One might be, oh, I've never heard of this guy and no fund, and so I'd rather, invest in, name brand. But what are some of the other cases against, that LPs hear against investing in early managers? What are some of the things that you have heard?
So, frankly, I don't think it goes really much past. They don't have a track record, so we don't know if they're good. That's
Yeah.
really by far the main reason.
Yeah.
Then because they're looking for social proof and there is none.
Social
And
proof. Yeah.
so exactly. And so the second thing they look for is that person what we call a spin out? Like, have they worked at the VC firm
Right.
before? So that's the second thing they're looking for, which, by the way, Lisa Clarkson is doing as well, and it's fine for her. It works for her. But the problem is, you then have to understand, were they successful in that VC firm because of the brand or because of themselves? And so how do you know that? It happened to me. I looked at a couple of funds like that. And in one of those, the founders had followed the GPs when they left the firm, which is great. So they had taken the money in the following round from those same GPs. So that's a good sign, right? But apart from that, I'm not sure how the fact that the GP knows how to invest already. I'm not sure that's something that's unbeatable compared to, do they have an investment thesis that they really, really resonate for? Because, for example, the first investment I did before your fund is in someone who's worked 15 years in energy and climate. And guess what? He's deploying a climate/AI fund. So he knows backwards everything. The way I invest in him was, I really looked at what he does with founders before he invests. And you and I had the same conversation. You told me, I remember when we spoke, that you're also already thinking of the next round before you invest in a founder. You're already thinking about that. You also have an experience as a founder, and maybe you'll be surprised, but you sent me your data room. I didn't open it. I never looked at anything in your data room. I looked at your interviews on YouTube. You had a few good interviews on YouTube where you're explaining about your life, about how you make decisions. You and I talked. You came to my event. I asked you questions. That's how I made my due diligence. Is for me what I'm interested. And I was right, because see, you're a student of decision making. Now you're here having this podcast. And because
I
for
am.
me, it's not for me. It comes from Aristotle. I think I have the book here. He said something 2,500 years ago that's so true. Is that the way you can judge of someone's character is by the way they make decisions. It's not even the actions. It's how do they make decisions. And so that's in my due diligence. That's what I'm trying to understand. Do you make decisions, as you said, because someone else is doing the deal and you have FOMO, or you have social proof, or you do have your first principles? Are you data driven? Are you questioning your own decisions? And you, Martin, told me, and you repeated in one of your podcasts recently, that you have this algorithm that goes and looks at all the passes that you made and try to understand, did I mess up? Difference between decision outcome and decision quality. So this for me is a great sign of someone who is taking the right decisions.
What they're building and will anybody buy it? You really got to dig into the CEO or the GP's decision making framework and how they make decisions, and if you agree that they're with how they approach decisions. And I've seen that as a common thing that frankly a lot of investors don't do. They overweight other people that might be investing, the size of the market, and, the terms of the round, even like, oh, it's a good deal. But at the end of the day, if the person executing the business has a poor decision process, it's not going to be a good outcome. Yeah.
Yeah, you could rely on luck, right? You said something. I think it was maybe your podcast with Sean, or maybe the first one. Exactly, you guys discussed decision outcome and quality, and it's so right, because you could be lucky. In VC, that's a problem, is that many people are lucky. I was lucky, like I had a
Yeah,
$2
sure.
billion exit. I was lucky once, and it was but really right time. Maybe I took a couple of good decisions. I was part of the team, mostly right time, and then the founder executed
Mhm.
excellently. But I haven't
Yeah.
done it twice.
Yeah. Well,
Yeah.
that's actually something I did when I put my thesis together, and I think I explained this to you. The reason I'm doing B2B software pre-seed, I talk about the 6 unicorns that I found in there. I actually have 12 unicorns in my portfolio, but 6 of them were lucky unicorns. I invested in a hydrogen company that became a unicorn. I invested in something else. But the reality was, I wasn't trying to replicate my luck. I was trying to consolidate my decisions around where I thought I had an advantage and where I thought I had some insight into a market that could be replicatable. Because for a GP, that's the key thing. I've seen it with other GPs. You said the guy was in energy for 15 years. Now he's investing in energy. You say, okay, that's understandable. I have a friend that was a B2B software VC for 15 years, and then he decided to change and go into climate. The biggest objection he had from LPs is like, what the fuck do you know about climate? Your whole track record is in a different category. And, I see that in founders a lot. It's like, I built a consumer app and now I'm building B2B. That for me is a bit of a flag because I don't think there's a lot of replicatable, decision-making process between those two. So I think it's fair to dig a little deeper into how the person makes decisions and do they have experience in the past that's going to be replicatable in the field that they're
Yeah.
doing.
Yeah, because what happens to me, and both what you said happens to me now as an LP, and before that when I was an investor, VC investing founders, is today I would really pause that intuition, that because that's again pattern matching. I'm thinking, okay, if you have 15 years in climate, maybe you understand better, but maybe not, right? Maybe you're going for the same solutions and you don't do anything disruptive. So I would still pause that intuition, and then that's the collect information bit, is trying to disprove that intuition and ask them, okay, so why are you here? Like, to your person you were mentioning who came out of B2B SaaS and doing something else. Why are you doing this? Is this something you understood, nobody else understood? Do you have another advantage here? Why are you doing it? If the answer is not convincing, just, oh, I prefer consumer better, okay, that's definitely not going to fly. But if, they come at it with another angle or something that we didn't think about, and actually every LP is not considering them for, better for me. That's where I get another advantage that nobody else has. So that's exactly the posing the intuition, stop the pattern matching for a second, ask questions, be open, try and disprove your early intuition, and then maybe your intuition was right, and then you can keep it, or maybe it was wrong and you should revise it.
So let's go back to when you decide to commit to the fund. Where did the confidence come from? I mean, you had your own pattern matching in the past and you did some diligence on me and the fund. What were and you said that you didn't look at the data room and you didn't look at, a lot of, you look more at the decision. So did the confidence come mostly from getting comfortable with how I make decisions and the category that I was in, or where did the confidence come from to actually say?
Yeah, first of all, I don't need super hard conviction to make a decision, because I think when you're trying to go for a lot of conviction, everyone's talking about conviction now, but the problem is most of the time, much of the time, it's you're trying to convince yourself anyway. So it's not real conviction. It's just, and so no, for me, it was really in this market, people who win have a different way of thinking and seeing the world. And that's
Have
my
different.
analysis. Yeah, exactly. My analysis of the parallel masters is that everyone's trying to find a common trait in great investors. And so that's why I publicly wrote an article where I called you a future parallel masters. So it's public, right?
That.
It's out there. Yeah, but I believe it. Otherwise, I wouldn't commit my reputation to it. And so my analysis was everyone's trying to find what's a great VC made of. And they talk about pedigree and they talk about access and network. And so my analysis was 5 points that they have. One being that they tend to see what can go right. They're not focusing on what can go wrong, right? They are willing to swing big. Okay. So what you said, right? You can just lose 1x, but you can miss 100x. So why don't you go all in? They are okay of being wrong, and something again that you're okay with. They have a low loss aversion, right? You are not afraid to being contrarian, right? And I know from your history where it comes from. You talked about it publicly, how your own history when you were 16 and left home and had to make your living. So I looked at that, I read that, I
Mhm.
looked at that, and I think it informs a lot of who you are today. And then, of course, the first thing is to have a high tolerance for risk, uncertainty, and ambiguity, which are the same thing. So for me, you had these 5 checks of the 5 personality traits I look for in VCs. And then conviction is I believe in my framework and I'm willing to put money behind it. And that's it. I don't need to be super super convinced that I'm right. But I tell you what, since then, I received your newsletter, your LP newsletter. I love them. They show a lot of an insight that I've rarely seen elsewhere. Everyone's on LinkedIn and Twitter and so on. And actually, you don't write about that on Twitter. I think you write on other things on Twitter. But
I
the
do.
insights you have on your LP newsletter, my God, like the how do you call it, SaaS apocalypse or SaaS? Every
SaaS
time there's a
apocalypse.
different term,
Yeah.
right? Yeah, yeah. So the way you explain, okay, everyone's telling you SaaS is gone, but that's what I believe. I mean, I don't know if you're right or wrong, but I really appreciate the insight you put in, the thought you put in, and it seems that you have a very unique point of view.
Thank you. And I'm looking for that in founders too. I was talking to a founder yesterday about raising a round, and I was like, you need to guide people of how you think you're going to get from where you are today, which is $2 million revenue to $10 million revenue. And you need to lay out the path. And he's like, well, I don't know how it's going to work. It might be different. It might be wrong. What if I'm wrong? And I'm like, it doesn't matter, because people want to see how you're thinking about it, and they want to see your process. And most investors know that it's going to turn out probably different. Every plan doesn't survive the first punch in the face. But what they want to do is understand the framework and how you're thinking about it. And they want to see that it's reasonable, that it's rational, that it is a little bit counterintuitive, that it has certain assumptions in here and there. But they want to see you're thinking about it. And many people get caught up in this thing of, well, I want to be right. Well, you're not going to be right about something 3 years from now, but the framework of how you think about it and what you're going to do when the things change is what people really want to understand. And you spent time to understand that with me, and I appreciate it. And I try to do that with founders too, is to understand how they're gonna make decisions. I had a call with a founder today, and he's like, I lost $300,000 of opportunities in my pipeline today. And I go, okay, well, let's go through them. What happened? Well, things happened outside of me. The people got more scared about offsite data storage versus on-site. And we went through all the objections, and I'm like, okay, well, what are you going to do to respond to what happened this quarter? How are you going to change your product or whatever? And he had a very rational and reasonable response to what happened. And we just walked through it. But I really appreciated the way that he thought about objections and obstacles that come. You mentioned Aristotle. I talk a lot about Marcus Aurelius, and he talks about the obstacle is the way. And something I spend a lot of time on, it sounds like you do too, is how's this person going to react to obstacles, right?
Definitely. And you had actually a great conversation. I think this one was with Sean on you looked at you said, I think, that YC had looked at the founders that had succeeded and what was their common points, right? I think you mentioned that in one of your second podcast. And what, if I remember correctly, you said YC came up with, it wasn't again about which school they went to, what they did, but the successful founders at YC seemed that they hadn't quit. I think that's what you said, right?
They said the only thing that correlated to whether a founder was successful is whether they would quit or not.
Okay, so I'm not sure it's adding to it, but changing it a little bit. I think for me, that's great. Great is perseverance and passion, so you don't quit, right? And I think what's even better, and going back to your point before of the founders who are running above the obstacles, is resilience. Resilience allows you to pivot. Grit, sometimes it can
Yeah.
lead you to do the same thing always, right? So you're gonna hit a
Yeah.
wall.
It can be
And if you
blinders
look
on.
at exactly, that's the Angela Duckworth concept. And then resilience even better. And then to go to your point to Marcus Aurelius, yeah, of course, if you want to go over obstacles, there's so much uncertainty. So all you can count on is someone who makes sound decisions, and maybe they're unlucky, it doesn't work. That's fine. I would still reinvest in someone like that because you can be unlucky. But the second thing is that is resilience. Are they able to take failure and make something out of it?
Absolutely. So someone that it's actually funny. My wife is. I don't know if your wife is this way, but she doesn't understand this whole risk thing. She's like, "Now wait a minute. You write 10 checks and nine of them are not going to work. How do you not? How do you sleep at night? Like I need things to be 90 successful. I want to be very secure and everything." She's like, "I could never do your job." And I'm like, okay, there are some people that are just not risk averse enough to do the job of a VC or to do the job of even being an LP in funds, is because you have to have a tolerance for risk. And one of the ways to measure that, to manage that also, is have a decision framework, like you said, on how to make the decisions, but also to you know, bet sizing. I tell people never to put all their eggs. I met a guy one time who was 90% of his balance sheet was in venture capital. And I'm like, what the fuck are you doing? It's all in crazy shit. Personally for me, I have 80% of my balance sheet in low leverage real estate and only 20%. It's just because I'm managing the resources to where, in the high risk, low information things that I do, if I lost money there, it wouldn't affect the rest of my
Yes,
life. That's
yes,
another
yes.
tactic to compensate for this lack of information, is to manage your bet sizing there.
Yeah, I totally agree. And fun stories. I used to work for a family office, and after I left the firm, I went to meet one of the members of the family with a friend, and he told the same thing. He said 80% of my wealth is in private equity. At the time, it was everything. And I came out of the meeting. I told my friend who was his son-in-law or something. How? Why don't you tell him that he should diversify? He said, yeah, but the thing is, he has like $1 billion, so he could live comfortably with 200 million, and then the rest is okay to lose it. It's fine. So it also depends on how much you have, right? So me, I don't have that much. So yeah, I write small checks.
Yeah.
But as you said, I'm comfortable losing that money also. It's fine. I don't need that for a living. And turns out now I'm starting talking to more and more LPs about that. And the first thing I tell them is, if you want to go to VC, go with your eyes wide open. Know that, don't ask for. I hate LPs asking for short liquidity. I mean, I have always, every time a GP pitches me on liquidity, I'm like, relax, dude. I know it takes time to build a company, so I know it takes time to build a great fund. Don't worry. So first, LPs should know about that. It takes time, right, for great funds to come through. And two, yeah, just put the money you're okay to lose, because this is super risky. I mean, it's still rare to make a lot of money. You have to be the top decile of funds today to make it worth the liquidity premium.
Okay. All right. Well, thank you for all that. Maybe if you could just summarize near closer to the end here, a takeaway. What are the I don't know if you want to re-summarize your mindset thing, the three ways you make low information decisions, but what are the two or three framework takeaways that people who are considering being an LP in a GP? What are the two or three frameworks they should use to make that decision?
So the first thing is, try and evaluate GPs as entrepreneurs, because emerging GPs are entrepreneurs
As
first, investors
entrepreneurs.
second. So look at how they build the company. Are they talking to startup founders? Are they testing the thesis, or are they just spending all the time talking to lawyers and paying hundreds of thousands of dollars to bring the fund up, and talking only to LPs and traveling to LPs? So what are they doing? How are they building the firm? That's one. And then two, really try and understand, and that's hard to do, right? I join investment committees of the funds I invest in usually, and but try and understand how they make decisions. Ask them about, why have you picked that founder? Why this one? What's your view on the market? And try and understand, are they trying to make first principle? Do they have first principle approach? Do they care about what other people think? I mean, that's for me what's really key, is that you have someone who's trying to win, and they're not just trying to not lose. They're really trying
Trying to win.
they're promotion focused. They're not prevention focused. They're not trying to preserve something. They're okay to bet their house based on their decisions.
Okay. Great. Well, thank you very much, Aram. Where can people find out more about you or this mindset investing if they want to? Your website or LinkedIn? What's the best way for people to learn more about you?
Best way is thevcfactory.com. I have all my articles, workshops, reports, everything. I'm also on LinkedIn, Aram Attar, but best place is thevcfactory.com.
All right. Well, thank you very much for your time, Aram, and I hope to come see you again in Austin soon.
Thanks, Martin.
All right.